today. Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady, where I help home business owners win the tax game. Home Biz Tax Talk airs Monday through Friday, 9 o'clock-ish. And when you tune into my show, you're going to hear about topics that are important to the home business community. All right, today's topic: how does the IRS build a case against your home business? Okay, this question comes in the form from one of our audience members that asked the question: will the IRS shut you down if you are making money but you're still showing a loss? Okay, so let's talk about that. So I really want to talk about how the IRS looks at this whole thing, right? Your whole business thing. So the first thing, we want to talk about the business versus hobby. All right. So the IRS looks at, have you been in profit 3 out of 5 years in your business? Okay. Are you operating in profit? And if the answer is no, that throws up a red flag. It doesn't necessarily mean that you're operating as a hobby. It's just the IRS says, okay. And so then if you keep showing this loss, you're like, we need to check some stuff out. Okay. So when they go and check some stuff out, this is what we're going to talk about today. All right. So when the IRS says that your business, they say, well, basically you have this hobby, you have an expensive hobby. Then with the hobby, you can only deduct up to the amount of income that you bring in. Okay. So that is the difference between a hobby and a business. But let's look at this whole thing. All right. So when you get started in business, you're a sole proprietor, okay, which is okay. This doesn't matter if you go and get a single member LLC, doesn't matter. One of the things that you check, the boxes that you check, is, did the taxpayer start the business in this tax year? Okay, so you check that box, and when you check that box, that's when the clock starts ticking. Okay, because when you're getting started in business, you're probably going to be operating at a loss because you are investing in the business and you haven't had a chance to sell anything yet. And investing in your business, it could be getting flyers, getting business cards. You might need equipment and all of that, right? So you're investing in your business in the beginning and you really haven't had the opportunity to sell anything. Okay, cool. So so that's when you get started. So then come next tax return, the IRS says, okay, so year 2, we're operating in a loss. Okay, cool. We'll just see what's going on. Then year 3, you're still operating in a loss. The IRS says, okay, but we still gonna check this out, right? So year 4 comes, year 5. Now you might not hear from the IRS for 5 years. You might not. Okay. But the one thing I want you to understand is there's a difference between making money and there's a difference in that and turning a profit, because see, you can generate income, but you're still losing money. So when you are still losing money after the 5 years, the IRS says, okay, so wait a minute. So we 5 years and we're still losing money. How are we still in business, right? How are we still operating, calling ourselves a business? How is this possible? All right. So then we look at the big picture. So you might have this 6-figure job, and all of these losses in your home business are being carried over to this 6-figure job. And then you are reducing your tax liability or increasing a refund. And the IRS goes, okay, so you basically using your job to fund this business. And then you're taking these losses and you're reducing the amount of tax that you owe. Well, let's go see if you are actually in business. So then you get a letter in the mail from the IRS that says, hey, we'd like to know more about this expense or that expense. Now, you're either going to have the information or you're not. Plain and simple. Okay. And you're going to have X amount of time to respond. So if they ask you for your mileage logs, if they ask you for receipts or whatever, and you can't produce that, then guess what? As far as the IRS is concerned, it didn't happen. So if it didn't happen, you can't prove that it happened, then the IRS says, that didn't happen. We'd like our money back, please and thank you. Appreciate you. Send us a check. Okay. So this is why I'm saying, you have to really look at this, because see, if you are, you might be using the products, you might be, a walking billboard for your company, but if you're not turning a profit in your business, the IRS is going, no, you're not deducting all these expenses if you are not actually turning a profit, running a business. Okay. Now, you might be in a business where, you're coming out of stuff. Now, if you can actually prove that you're in business, that you're actually trying to turn a profit, and there are specific things that the IRS will ask you. They'll ask you, did you talk to someone who did not have a financial interest in your business? So if you say, and if you are a network marketer, for instance, and you say, well, I talked to my sponsor, your sponsor is not your business coach. The reason is that your sponsor has a vested interest in you staying in that company and you keeping your auto ship and you buying the products and you attending the events. There's a financial interest there. So no, that is not your coach. They're asking you, did you talk to someone outside of this profession to help you to be better in business? Did you hire a business coach? Did you try different methods of selling? If you say, okay, well, I stood out the mall and I gave out 50 samples a day for 365 days. And so the IRS is saying, okay, so if that didn't work, what else did you try? And if you can't say that you tried something different, they're going to say, no, we'd like that back. Please and thank you. They're looking to see, do you have, wait for it, a business plan? You mean to tell me I need to have a business plan for my network marketing business? Shut the front door. Absolutely. Your comp plan is not a business plan. Your business plan is going to say, okay, who am I? Who am I in the marketplace? What is my unique selling proposition? Who is this? Who am I that makes me different? Who is my competition? SWOT analysis, strengths, weaknesses, all of that. They're looking for your plan. How you plan to make money. Do you have one? No? Okay. So the IRS is saying, dude, you are not doing the things necessary to be in business, to be a viable business. Now, if you can show that you've done all of those things, okay, great. But if you can't, that's when they go back and say, okay, we need to look at some other stuff. Okay. And this is what happened to a couple in Florida with an established network marketing company. Okay. This couple, both of them were high 5-figure earners. Okay. And this is over the course of 5 years that this happened. Okay. So they used the products. They sold some stuff. Okay. They sold some stuff. They went to all of the events. They went to all of the meetings. They did all of this stuff. And every year they showed operating at a loss. The IRS audited them and disallowed all the expenses. And they had to go and write checks that come with interest and penalties. So it's not the fact of, are you making sales? Yes, you can make sales, but still be operating at a loss. And we're not talking about losses that are produced by, like, people like, well, what about the home business, the home office tax deduction? You can't produce a loss with the home office tax deduction. Okay. Mileage is one of the most audited things with home businesses because it's basically the highest paying tax deduction in a home business. And if you cannot produce those clear mileage logs that shows the date, where you went, the from and to, the number of miles, why you went there, and for what purpose, if you can't produce mileage logs like that, the miles didn't happen. That 54.5 cents per mile for 2018, whatever that deduction is going to be disallowed. Okay? So the IRS, so when you first getting started, you're losing money. The IRS is like, okay, cool. That happens, but we watching. Okay? Year 2, we watching.
My apologies.
Oh, and And I don't know why. Look, my phone is talking about I don't understand. Guess what? A lot of other people don't understand either. But the thing about it is year two, they're like, okay, we're watching, right? And then once they continue watching and they say, okay, no, we're not turning a profit yet. You're underpaying your taxes. Okay, then they come in for their money. If you're writing and then they find out you're writing off ridiculous stuff, like, somebody told you that you could write off your hair, your nails, your clothes and all that, and you wrote that stuff off, they will come for you. So this is not something that I heard. This is something that I know and I have seen happen. So I really want you guys to understand that this is not something that might happen today. Might not be something that happened tomorrow, but you need to be expecting to make money in your business. And so let's say, for instance, that, hey, you're going along, you're still losing money, but you're not losing as much money. Okay. So then you can show the progression that your income is increasing and that your business losses are decreasing so that you're getting to the point that you're making money. You can actually ask the IRS to extend the time that they look at your business, but you better be making some money. There's actually a form. I forgot the form number. I think it's a 5213, but don't quote me. But there's actually a form that you can file that says, hey, IRS, I realize that I'm not making money like I should, but give me a little bit more time and we'll make these things happen. And the IRS, I was like, okay, cool, but we're coming. So if you aren't turning a profit by then, they're auditing all of your stuff. And if they feel like, or if they can prove that you did something fraudulently, there is no statute of limitations on fraud. They go back through all your stuff. And if you are going into business, you need to be going into business to make money. Let go of the refund. If you are in business and you are turning a profit, thou shalt pay taxes. Let go of the refund. Business owners do not get refunds unless they overpay in their estimated taxes. Or if you've got a job and you've had more, if you and a spouse and your spouse has withheld in their job and you've overpaid in your taxes, then you'll get a refund. But listen to me, business owners pay taxes. Even if you pay estimated taxes, you still got to pay. You might get a refund at the end of the year, but you still have to pay. And so what I want you to understand is that you have to go in the business with the mind to turn a profit. And when you are turning that profit, when you are making that money, you need to set aside 30% of your income for taxes, because business owners you pay federal taxes. Some 43 states charge state income taxes. You pay business privilege taxes. Depending on where you are, you pay business privilege taxes at the state and at the locality. And if you decide that you want a single member LLC, that's great. You have annual filing fees. The first 6 months of the year is the most checks you're going to write to the government when you are a business owner. Okay? That the first 6 months of the year, you writing the most checks. So what I want you to understand is that even though you might not hear from the IRS, it doesn't mean they're not watching. Okay? And so they go back and they look over time. They look over that 5 years and say, okay, well, we see nothing but losses here. If you are losing all of this money, how are you in business? It does not make sense. Now, if they go pull a credit report and show that, you're living off of credit cards, okay. Yeah, the IRS does that. They go look at your credit report. Have you been missing any bills or anything like that? They look at all of this big picture stuff to see, okay, are we really in business, or are we just offsetting this income so they don't have to pay taxes, or are they trying to create a refund? Okay? They're looking at that whole thing. And if you save up this money for taxes, you guys, let's say you get to tax time and you don't need that much money. Well, fantastic. Write your check and then go and save the rest, or go reinvest in your business or something. But you want to make sure you're prepared to write the check. All right. So they're not looking at just your income. They're looking at the bottom line. Are you in a net profit or a net loss? If you're operating at a loss, how long have you been operating at a loss? Are the losses staying stagnant? Are they increasing? Are they decreasing? Okay, can you show us this information? Can you show us that information? If you can't show and tell when the IRS calls, okay, if you can't produce, you know how when they play in poker and they're like, I call, and you got to lay your cards down. That's exactly what the IRS lay these cards down. If you ain't got no cards, guess what? You lost. And so this is why I want to be clear with you that you have to go into business to make money. Hiring a business coach is not a bad thing. We will hire business coaches in a minute, but you also need to be sharp on this bookkeeping. You need to be sharp on preparing for these taxes. You need to be sharp on all that stuff. Okay, because see, that is what's going to, paper is the only defense you have in the IRS. Because you are guilty unless you can prove yourself innocent. If you can't prove yourself innocent, boo, guess what? You're going to write the check back to the government, period. Okay, so I hope that gives you some insight on how this whole thing works. Okay, number one, you need to go into business with the expectation of making money. If you're continually losing money, you need to rethink your processes. Do you need to hire a coach? Maybe this business isn't for you. I will give you a prime example. When I got into the home business industry, I started with a popular cosmetics company. Okay, and why I thought I could make my living planning parties, and I didn't even like to plan my kids' birthday parties. I'm terrible at that. What? So I had to leave that alone. I was like, no, this is not for me. It is, and it's okay. All right. But this is why you can't go to your sponsor for this type of counsel, because see, they're looking at their own wallets. Like, oh my gosh, if this person quits buying, I'm going to lose X amount of money. So we need to say what we need to say to keep them in this business, right? Go reinvest in your business, stock up all this inventory and all that stuff. Yeah. Having inventory on hand is a great idea for a network marketing company, but not if you're not selling it. You see all of these, people that did not work out with network marketing. They're trying to sell this stuff off at a loss when you probably could have just not bought it in the first place. I know I'm about to upset some folk now, but let's go with the truth. Okay. So you've got to find that thing that works for you. If that's not where you are right now, that's okay. But when the IRS looks at this stuff, these are the questions that they're asking. Did you hire a coach? Did you change anything about how you were generating sales? And oh, by the way, who did you talk to? Let us see your calendar. And they will call the check. Okay, don't act like the IRS will not call and say, hey, Sonia, we were looking at Lysandra's calendar here, and we showed that you all had a business meeting on June 15th at 6:30 p.m. Do you recall such a meeting? And Sonia be like, I wasn't there. What? Okay, yeah, the IRS will call and check the people in your calendar. They will do that. But even if you don't even have a calendar to produce that shows that you talk to people about your business, how you gonna say you tried to sell stuff? If you are in a network marketing company and you give away samples, I'm going to say this and then I'm going to get off because I've been preaching on this for too long. But if you are in a network marketing company that deals with samples, you need to document who you gave your sample to, the date, their contact information, and you need to follow up with them. Don't just go out giving samples, because if you now that's a business thing, but it's also an IRS thing. Because see, if you're writing off samples and saying, I gave them out to customers, the IRS saying, okay, who did you give these samples to? Did you follow up with them to make a sale? So if you giving out samples, don't just be giving out random samples. You need to document who you gave them samples to. So that if you're not turning a profit right now, you can say, okay, listen, I gave this sample to Delshawn. I called her. She didn't like the taste. Okay, great. And so even using that, then you can build your own data. Okay, I gave this sample out to 20 people. They didn't like it. So you know what? Maybe that's not a good product for me to sell. So these are all the things that the IRS looks at, and they say if you did not do these things, then you are not in business. And you have an expensive hobby. We're going to disallow these expenses, and we would like our money back. Thank you. Quickly. All right. So I really hope this gave you something to chew on today, guys. We're talking about making money in the home business industry. Listen, you have to be smart about your money. You have to really do what's best for you. You have to be confident enough in yourself to know what is the right move for you to make. And if you don't, you need to get someone who is not involved in that business, that's not financially involved. That means your upline, your upline's upline, anybody that can make money off of you being in business. Those are not the people to talk to. No. Okay. So that's it. That's it for me, you guys. Thank you guys so much for tuning into Home Biz Tax Talk. Again, we air Monday through Friday, 9 o'clock-ish, and you can come here to get your questions answered about your home business taxes. All right. Have a great day, and I'll see y'all next time. Bye.